In today's episode of the Daily Brief, I'll talk about two interesting stories. I first talk about RBI's latest MPC meeting, and then I talk about what's happening in the steel industry. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host Tarun, and today is the 9th December. You can find us on Spotify, Apple Podcasts, or wherever you consume your podcast. The Daily Brief is also available in Hindi. And if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the comments below. Let's start with the first story. The Reserve Bank of India, or RBI, just held its latest Monetary Policy Committee or MPC meeting, and here's what came out of it. The repo rate, the interest rate at which the RBI lends money to commercial banks, remains unchanged at 6.5%. The stance, neutral, meaning no bias towards raising or cutting rates. The cash reserve ratio, or CRR, the portion of money banks must park with RBI, has been cut by 50 basis points or 0.5%, releasing 1.16 lakh crore into the system. But these numbers don't mean much on their own. Let's make sense of them by asking the tough questions with added context and then try to answer them too. Growth. Why is it slowing? What can bring it back up? Why didn't RBI cut rates to boost it? Inflation. Why did it spike? Will it cool down soon, or are we stuck with high prices? CRR versus rate cut. What's the difference, and why go with a CRR cut instead of a rate cut? Let's first set the stage. Everything we're discussing here boils down to one thing: balancing growth and inflation. It's a tightrope walk, and one wrong step could send the economy tumbling. What's going on with growth? India's growth in Q2 FY 24-25 slowed down to 5.4%, falling well below expectations. So, what went wrong? On the demand side, things looked weak. People are spending less, causing private consumption to dip, while businesses are holding back on investments. This has created a drag on overall economic activity, affecting areas like retail and services. On the supply side, the industrial sector's performance has been disappointing. Manufacturing, mining, and electricity, major contributors to growth, struggle due to low demand and supply chain issues. On top of these domestic challenges, global headwinds added to the trouble. A strong US dollar, trade tensions, and geopolitical uncertainties have made the external environment tougher for India. But it's not all bad news. Growth hasn't collapsed. RBI Governor Shaktikanta Das pointed to signs of recovery. Robust Kharif food grain production, strong Rabi prospects, increased government spending on infrastructure, and a resilient services sector. GDP growth is projected to rise to 6.8% in Q3 and 7.2% in Q4 FY 24-25. While growth is a concern, it's not yet an emergency. That's why the RBI chose not to cut rates. What about inflation then? Inflation surged to 6.2% in October, breaching the RBI's comfort zone of 4%, plus or minus 2%. The primary culprit was food inflation, driven by unseasonal rains, supply chain disruptions, and global price volatility in key commodities. However, there's a silver lining. Forward projections suggest inflation could ease to 4.5% by Q4 FY 24-25, supported by a good Rabi harvest and a seasonal correction in vegetable prices. The RBI isn't hitting the panic button just yet. They're closely monitoring the situation, especially since high food inflation hasn't spilled over into core inflation categories like housing or services. But if inflation doesn't settle as expected, all options will remain on the table. Alright, so we've got growth concerns on one side and inflation worries on the other. But here's the thing, the RBI's decisions aren't random. They're carefully calibrated to balance these two opposing forces. And that's where the inflation versus growth trade-off comes into play. Let's break it down. Option 1, lowering repo rates. Cutting repo rates is the go-to move when you want to boost growth. Why? It makes borrowing cheaper for businesses and consumers, encouraging them to invest, spend, and drive the economy forward. But here's the catch. When demand surges without a matching increase in supply, prices can skyrocket. And remember, in October 2024, inflation had already spiked to 6.2%, way beyond RBI's comfort zone. Adding more demand to the mix could have made things worse, especially when food prices were already through the roof. Option 2, maintaining repo rates. By keeping the repo rate steady, the RBI took a cautious approach to inflation control. Stable borrowing costs help prevent demand from overshooting and keep inflation expectations within their 4%, that is the plus or 2% target. But this comes at a price. Businesses facing higher borrowing costs might cut back on expansion plans, and consumers could hold off on big ticket purchases. With private consumption already weak, this isn't exactly a recipe for a quick recovery. Option 3, cutting CRR. Now, here's where the RBI got creative. Instead of cutting rates, they slashed the cash reserve ratio or CRR by 50 basis points. This move released 1.16 lakh crore into the system, giving banks extra cash to lend. While theoretically this is what RBI argues, some experts like Deepak Shenoy think otherwise. He says banks are still flush with liquidity. However, it would help if the RBI had to aggressively sell more dollars and remove rupee liquidity. So why no rate cut then? Here's the RBI's thought process. They believe growth recovery is already on the horizon thanks to strong agricultural output, government infrastructure spending, and a resilient services sector. Cutting rates now might overstimulate demand, which would be like throwing more wood on an already blazing fire. Instead, they've chosen a path that supports growth without risking inflation spiraling out of control. What is the key takeaway from this MPC meet? The RBI's policy is like playing chess. Every move impacts another and the flexibility is key. India, as a developing nation, can't afford to go all in on one strategy. Developed countries can print money or run deficits without blinking. We can't. We need room to adjust to unexpected shocks, both global and domestic. That's why the RBI kept rates steady but cut CRR, a smart compromise to maintain balance. Were they right? Honestly, we won't know until we look back months from now. But here's the thing. Their job is to take tough decisions, and our job is to explain those decisions without putting you to sleep. Until the next policy review, we'll keep an eye on growth, inflation, and liquidity while RBI keeps walking on the tightrope. Because let's face it, balancing an economy isn't easy. Imagine you're a food vendor at a bustling street market. You've spent years perfecting your recipes, sourcing the best ingredients, and building trust with your customers. But one day, a giant food truck parks next to your stall and starts selling the same dishes at half the price. Turns out they're cutting corners, using cheaper ingredients, and selling at a loss just to grab all the customers. You try to compete, but it's a losing battle, and soon your business starts to suffer. That's exactly what's happening in the steel market. China is flooding the global market with cheap steel, making it nearly impossible for countries like India to compete on a level playing field. China is the world's biggest producer of steel. In fact, it makes over 1 billion tons of steel every year, more than half the world's total steel production. To put that into perspective, India, the second largest producer, makes about 125 million tons. But here's the problem. China doesn't need all that steel. Its economy is slowing down and its domestic demand is not as strong as it once was. So instead of letting its mills sit idle, China has started dumping cheap steel on global markets, including India. This steel isn't just any steel. It's being sold at extremely low prices, sometimes lower than the cost of production. This strategy helps China keep its steel mills running and maintain employment, but it creates a huge problem for countries like India, where local producers now have to compete with these incredibly cheap imports. In 2023, China exported about 90 million tons of steel, up 35% from the previous year. Indian steel companies like Tata Steel, JSW Steel, and others have invested billions of dollars into building high-quality products. But now with Chinese steel flooding the market, they're finding it harder and harder to sell their own products without slashing prices or losing market share. Take the US for example. To protect its own steel makers, the US imposed high tariffs on Chinese steel years ago. But China found a workaround. Instead of exporting directly, it sent steel to countries like Vietnam, which then ship it to US under the radar. This tactic helps China bypass tariffs and still flood the market. In Asia, China's steel mostly flows through places like Vietnam, South Korea, and the Philippines. But India has become one of the biggest dumping grounds thanks to free trade agreements or FTAs with countries like Vietnam and South Korea. These agreements allow steel to come in at little to no tariff, making it even harder for Indian companies to compete. India's finished steel imports from China reached at an all-time high during the first 7 months of the current financial year from April. China shipped 1.7 million metric tons of finished steel to India during April-October, a 35.4% increase year-on-year. Sajjan Jindal, the chairman of JSW Steel, has openly criticized this practice. He has pointed out that China is exploiting the FTA route to dump steel in India, which is harming its local steel makers. Tata Steel CEO has also raised concerns, saying that if this continues, Indian steel companies might think twice about making long-term investments. After all, who would pour money into expanding production when the market is flooded with cheap imports? The government is aware of the situation. In response, India's Steel Ministry has proposed a 25% safeguard duty on steel imports. This would help protect local producers from the surge in Chinese steel. But this proposal is still on the table and it hasn't been finalized yet. The proposal came at a meeting between Union Minister of Steel H.D. Kumaraswamy and Commerce and Industry Minister Piyush Goyal on December 2nd, amid concerns about large influx of steel imports into the country, particularly from free trade agreement countries. Here's what Piyush Goyal said on X, formerly known as Twitter. According to Kumaraswamy, the two ministries discussed ways to collaborate and ensure ease of doing business for domestic players. This is a huge issue because steel is the backbone of many industries: construction, infrastructure, automobiles, and even consumer goods. And India's steel industry is massive. It contributes about 2% to the country's GDP and employs millions, directly or indirectly. If Indian steelmakers can't compete with cheap imports, it could slow down infrastructure projects, increase unemployment, and limit future growth. In fact, Tata Steel and JSW Steel have warned that without a fair playing field, investments in new projects could grind to a halt. This would hurt not just steel companies, but the economy as a whole. And it's not just businesses that will feel the heat. Every day, people like you and me will be impacted too. While it might seem like cheaper steel imports could lower the prices of products we buy, like cars, home appliances, and the like, there's a hidden cost. If Indian steelmakers struggle or close down, India could end up depending on imports for steel. And when we are reliant on other countries for something as fundamental as steel, we risk exposing ourselves to price fluctuations and supply chain disruptions. And here's the tidbits for today. SEBI proposes a 15-minute call auction session to replace the volume-weighted average price for closing stocks. This move aims to reduce tracking errors for index funds and improve market efficiency, aligning with global practices. The Indian wedding industry is set to hit $6 trillion in 2024, driven by rising cost and millennial spending. With 42% self-funding weddings and loans growing to 20%, millennials are reshaping the sector while fueling demand across jewelry, hospitality, and fashion. Russia has invested $20 billion in India with a focus on energy and manufacturing. Bilateral trade, driven by discontinued oil imports, reached $65 billion in 2023 as both nations aim to deepen ties and achieve $100 billion in trade by 2030. NHAI's 1,000 crore green bond issue will fund eco-friendly initiatives on the Delhi-Mumbai Expressway, including renewable energy and rainwater harvesting. This marks a first for India's highway sector in green financing, boosting ESG-focused investments. And that's it for today. We'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.